Ever get that nagging feeling your bank isn't telling you the whole story about your credit? Like there are hidden levers and dials you could be adjusting. If only you knew they existed. Well, what if I told you that your bank actually thrives when we misunderstand certain things about credit scores and credit cards? It's true. Some studies show a lot of us are missing some basic financial knowledge, which makes tricky money decisions even harder. This isn't about banks being evil masterminds, it's just business. But let's be honest, their business model, especially with credit, often works out better for them if we stay a little in the dark. Today we're flipping on all the lights. Welcome, you're here because you suspect there's more to this whole credit game than just paying your bills on time. And guess what? You're absolutely right. For years, the credit industry has felt kinda like a complicated maze. Banks and credit card companies, they give us services we need, no doubt, but they're also businesses out to make a profit. And often that profit comes from us doing things that aren't always in our best financial interest. Things like carrying big balances, paying fees we don't need to, or just not knowing how to really get our credit profile working for us. They might not be actively hiding stuff, but they sure aren't shouting from the rooftops about the strategies that could save you the most money or give you the most control. Think about it. If everyone knew exactly how to manage their credit perfectly, get all the rewards without the downsides, and pay as little interest and fees as possible, well, the bank's profits would look a whole lot different, wouldn't they? This isn't some wild conspiracy theory. It's just about understanding how the system is built. In this video, we're pulling back the curtain on 5 crucial credit secrets. These aren't sketchy loopholes or weird hacks. They're real, fundamental truths and solid strategies that put you in the driver's seat. Knowing these secrets can help you boost your credit score, save a serious chunk of money, and finally feel in control of your financial health. In a way, banks might rather you didn't. We're not just talking small tweaks here. We're talking about understanding the game so well you can make it work for you, not the other way around. So grab a metaphorical flashlight, because we're about to explore some of the dimly lit corners of the credit world. Secret number 1, your credit score is way more flexible than you think. All right, the first secret, and honestly, it's a game changer. Your credit score isn't some number set in stone. It's alive, it's dynamic, and it reacts to what you do or don't do much more than most folks realize. Banks might like it if you see your score as this super complicated thing best left to the experts. But the truth, you've got a ton of power to shape it, often quicker than you'd think. What many people don't quite get is how much different things matter. The 2 biggest players in the FICO scoring model, that's the one most lenders use, are your payment history, which is a huge 35% of your score, and how much you owe, especially your credit utilization ratio, which is another 30%. That's a massive 65% of your score hanging on just those 2 things. Let's break it down. Payment history is pretty simple. Pay your bills on time every single time. Super important. Even one missed payment can make your score dip. And of course, banks love those late fees. But the amounts owed part, especially credit utilization, is where lots of people miss out on chances for quick wins. Credit utilization is just the percentage of your available credit you're actually using. So if you have a credit card with a $10,000 limit and a $3,000 balance, your utilization is 30%. Experts usually say keep this below 30% on each card and overall. But here's a pro tip. People with the highest credit scores, they often keep their utilization in the single digits, ideally under 10%. Now, why is this a secret? Banks aren't screaming from the rooftops. Well, they want you to be a responsible borrower, so you pay them back. Sure, but they also make a lot of money when you carry balances. Interest charges on revolving debt. That's a gold mine for them. If everyone kept their utilization near zero and paid balances in full before interest hit, bank profits from credit card interest would seriously tank. Here's where the flexible part comes in with a smart move. Did you know most credit card companies only report your balance to the credit bureaus once a month, usually on your statement closing date? This means even if you pay your bill in full by the due date, if you had a high balance when that statement closed, that's the high utilization that gets reported and affects your score for the next month. The trick here is to make payments before your statement closing date, especially if you've made a big purchase. By paying down the balance right before the statement closes, you make sure a lower utilization ratio gets reported. This can give your score a surprisingly fast boost. Imagine you charge $2,000 on a $5,000 limit card for something you need. If that $2,000 is still there when the statement closes, your utilization for that card is 40%. But if you pay off $1,500 before the statement date, leaving just a $500 balance, your reported utilization plummets to 10%. That one move can make a real difference quickly. And get this, errors on credit reports are really common. An FTC study a few years back found that 1 out of every 5 people had an error on at least one of their 3 credit reports. These errors can be small things or they can be serious, like accounts that aren't yours or late payments reported by mistake. Any of these can drag your score down. Banks aren't going to find these errors for you. It's up to you to check your credit reports regularly from all 3 major bureaus: Experian, Equifax, and TransUnion. You can do this for free every year. If you find an error, dispute it right away. Getting a big error removed, like a collection account that was never yours, can make your score jump significantly. So, making your score more flexible isn't magic. It's about understanding these key pieces, paying on time, smartly lowering your utilization, and keeping an eye out for errors. Focus on these, and you can actively and often pretty quickly improve your credit. That means better loan terms and saving thousands in interest, something banks aren't exactly rushing to teach you. Secret number 2. Yep, you can negotiate credit card fees and rates. This next secret could literally put money back in your pocket, often with just a simple phone call. Many credit card fees and even your interest rates aren't carved in stone. They're often negotiable. Banks and credit card companies usually hand you terms and conditions that look like ironclad contracts. And yeah, the fine print is a nightmare, but there's often more wiggle room than they let on, especially if you're a customer they want to keep. Take annual fees. Lots of rewards cards have them, anywhere from under $100 to over $500. Sometimes the benefits are worth it, but for others, it's just wasted money. What many cardholders don't realize is if you call your card issuer and say you're thinking about closing the card because of the fee, they might just offer to waive it for a year, reduce it, or give you some bonus points or a statement credit that cancels it out. Why would they do that? It's all about keeping you as a customer. It's usually cheaper for them to keep you happy, even without that fee, than to find a new customer. Plus, they might still be making money from interchange fees every time you swipe the card. The same idea applies to other fees Like late fees. Look, life happens. Even the most organized person can miss a payment due date once in a blue moon. Instead of just eating that $30 or $40 late fee, call your credit card company. If you've got a good payment history, a polite request to waive the fee as a one-time courtesy often works. They want to keep good customers happy. I read an article recently that said something like 85% of people who ask for a lower credit card APR actually get some kind of reduction, but less than 15% of us ever even make that call. But maybe the biggest win you can negotiate is your annual percentage rate, or APR. That's the interest rate you pay if you carry a balance. If your credit score has gone up since you got the card, or if you've been a loyal customer who always pays on time, you're in a great spot to ask for a lower interest rate. Banks aren't just going to offer this out of the blue. You almost always have to ask. A lower APR can save you a ton of money if you tend to carry a balance or you're trying to pay down debt. Before you call, do a little homework. Know your current rate, check what competitors are offering. Some banks might match or beat them if you mention it. And be ready to point out how good of a customer you've been. Sometimes just asking to speak to the retention department is the key. Those folks often have the power to make better offers to keep you from leaving. And what if they won't budge on the annual fee for that fancy card and you realize the benefits just aren't worth it anymore? Don't just close the card, especially if it's one of your older accounts. Closing an old account can shorten your average age of credit history, which can actually lower your score. Instead, ask if you can downgrade the card to a no annual fee version from the same bank. This way, you keep the account open, keep its history, and ditch the fee. Banks don't usually shout about this downgrade option because they'd rather you keep paying for the premium card, or if you're unhappy, close the account, which might make you open another one of their products later. Why is this a secret? Because the whole fee and interest setup is a huge part of how they make money. Every fee they waive, every interest rate they lower directly cuts into their profit on your account. They're counting on most of us to just passively accept the terms they set. By knowing that negotiation is on the table, you switch from being a passive consumer to someone who's actively looking out for their own wallet. The worst they can say is no, right? But very often a polite, well thought out request gets you a yes. Credit card sign-up bonuses and those ongoing rewards programs, banks push them hard for a reason. They're amazing at getting new customers and encouraging us to spend. They dangle these shiny offers like spend $3,000 in 3 months, get 50,000 bonus points, or 0% APR for 18 months. These can be super valuable for sure, but the secret is knowing how to strategically get the most out of them without falling into the traps banks are kind of hoping you'll hit. The secret part here is that banks are banking on a certain number of us to mess these offers up. For example, with those big sign-up bonuses, they hope the temptation of the bonus will make you spend more than you normally would. Then you might end up carrying a balance and paying interest that completely wipes out the value of the bonus. Or they hope you'll get so used to the card that you'll just keep paying that annual fee year after year, even if the card's perks don't really fit your spending anymore. So how do you play this smart? First, with sign-up bonuses, be real about that spending requirement. Don't apply for a card if the minimum spend is way more than you'd usually spend, because that's just asking for debt. But if you've got a big purchase planned anyway, like new appliances or a vacation, timing your card application to match that purchase can help you hit the target without changing your habits. Once you've snagged that juicy bonus, and maybe before that next hefty annual fee is due, you've got options. You can downgrade the card to a no-fee version if they have one, like we talked about in secret number 2, or in some cases, cancel it. But be careful with canceling too often, sometimes called churning. Banks are catching on and might have rules against it, like only giving you a bonus once every few years for the same card family. Plus, opening and closing accounts a lot can ding your average age of accounts and rack up multiple hard inquiries, which can temporarily lower your score. It's a bit of a balancing act. When it comes to ongoing rewards, cashback, points, or miles, the trick is to pick a card that actually matches how you spend your money. If you hardly ever travel, a fancy travel rewards card with a high annual fee doesn't make much sense, even if the points seem super valuable. A simple cashback card might be way better for you. So many people sign up for cards with cool rewards, but then don't fully use them, or they let points expire. It's key to keep track of your rewards and know the best way to redeem them. Some cards give you better value if you use points for travel through their website, while for others, straight cashback is the best deal. The biggest warning, and the one banks quietly make money from, is carrying a balance on a rewards card. The interest rates on rewards cards are often higher than on basic no-frills cards. If you carry a balance and you're paying, say, 20% APR, you are almost certainly paying way more in interest than you're earning in rewards. The absolute golden rule of rewards cards is pay your balance in full every single month. If you can't stick to that, the rewards game isn't for you, and you're just playing into the bank's hands. Banks also love what they call breakage. That's a fancy term for rewards and benefits that go unused. They offer a whole bunch of perks, knowing that a lot of cardholders will forget about them or just not bother to use them. This could be anything from travel credits and airport lounge access to purchase protection or extended warranty benefits. Make it a habit to look over your card's benefits guide at least once a year. You might be surprised at the value you're just leaving on the table. Some apps can even help you track rewards and benefits across different cards. So the secret is to be an active, smart player in this game. Pick cards that fit your normal spending, hit those sign-up bonus goals without overspending, always pay in full, and actually use all the perks you're entitled to. That way, you get the maximum value and the bank isn't profiting from your debt or forgotten benefits. Secret number 4. Banks make money from your spending habits and your debt. This secret gets into the basic dollars and cents of how banks, especially credit card companies, make their money. Now, it might seem obvious that banks profit from the interest on our debt, but the scale of it and the subtle ways they nudge us towards certain behaviors aren't always crystal clear. Understanding this can completely change how you look at your credit cards and your spending. The most famous profit source is interest on revolving balances. When you don't pay your credit card bill in full by the due date, the leftover balance starts racking up interest, often at a painfully high APR. Banks make huge profits from customers who consistently carry balances, and even more from those who only make the minimum payment. That minimum payment, it's a carefully calculated amount designed to keep you in debt for the longest possible time. So the bank collects the most interest. Seriously, paying just the minimum on a big balance can mean you're in debt for years, maybe even decades. and you could end up paying 2, 3, or even 4 times what you originally borrowed because of compound interest. Banks love the minimum payment because it's a steady, long-term cash cow for them. The secret here isn't that interest exists, it's how massively the minimum payment is tilted in their favor, not yours. They don't have to shout from the rooftops about how much extra you'll pay or how much longer you'll be in debt if you only make minimum payments, though that info is usually buried in the fine print of your statement. But interest isn't the only way to make money from your card. Every time you swipe your credit card, whether you pay your bill in full or not, the merchant, meaning the store, restaurant, or website, pays an interchange fee. This fee goes to the payment network like Visa or MasterCard and your bank. It's usually a percentage of what you bought plus a small fixed fee, often somewhere between 1% to 3% or even more for fancy cards or certain kinds of purchases. While the merchant pays this fee, it's money for the banks that your spending generates. This is a huge reason banks are so eager to get their cards in your wallet and why they try to get you to use them with rewards points. They earn this fee even if you don't carry a balance. So when a bank waives your annual fee, they're still counting on making money from your interchange fees throughout the year. This isn't necessarily a bad thing, but knowing it helps you see why they push card usage so hard. Banks also make money from all sorts of other fees, late payment fees, which we talked about, cash advance fees, which often have a higher APR that starts piling up interest immediately, balance transfer fees, even on those 0% APR offers, foreign transaction fees, and sometimes even fees for things like paying your bill faster or getting a replacement card. While you can avoid some of these, they add up to a big income stream from customers who aren't watching their accounts closely or who get into a tight spot. The biggest secret is that the whole system is kind of designed to encourage spending, and for the banks, ideally for us to carry at least some manageable debt. How easy it is to just tap a card, the fact that it feels less painful to pay with credit than with cash, the lure of rewards, it all subtly nudges us towards spending more. Credit cards are super convenient tools, no doubt, but understanding all this helps you use them more consciously. Are you swiping your card because it's a smart financial move for that purchase, or are you being gently pushed by a system designed to boost bank profits? By understanding these profit motives, how much they rely on interest from carried balances, especially those minimum payments, and the steady cash flow from interchange fees on all your spending, you can make much smarter decisions. Make it your top priority to pay balances in full to dodge that interest. Be mindful of fees. Use credit as a tool for your convenience and your benefit, not as something that primarily makes banks richer at your expense. This awareness really helps you see the credit world with your eyes wide open. Our fifth secret brings us back to credit utilization. But this time, we're focusing on how you can proactively manage it and your credit limits to really boost your score and your financial standing. These are tactics banks don't exactly shout about. We know that keeping credit utilization low is key for a good score. It's 30% of your FICO score, remember? But a lot of people are just reacting to their utilization, not actively managing it. One of the best but often missed strategies is to ask for a credit limit increase on your existing cards. If your spending stays the same but your credit limit goes up, your credit utilization ratio automatically goes down. For instance, if you have a $2,000 balance on a $5,000 limit card, your utilization is 40%. If your bank bumps your limit to $10,000 and your balance stays at $2,000, your utilization drops to a much healthier 20%. This can give your credit score an almost instant lift. So, when's a good time to ask? If your income has gone up, if you've had a good payment history for a year or more, or if your credit score has generally improved, you're in a strong position to request an increase. Many banks even let you ask for this online through your account portal. Often, you'll get an instant decision, and it's usually a soft pull on your credit, which doesn't hurt your score. Some banks do a hard pull, so it's smart to ask which type of inquiry they'll do. But even if it is a hard pull, the small, temporary dip from one inquiry might be well worth the long-term win of a lower utilization ratio. Why don't banks push this? Well, while they want you to have credit available so you can spend and generate those interchange fees, they also make money when people get close to their limits and are more likely to carry balances and pay interest. A higher limit, if you use it responsibly, gives you more control over your utilization. They might also be a bit hesitant if they see you as a higher risk, since a higher limit means more potential loss for them if you couldn't pay. Another strategy is how you use multiple credit cards. Some people think having lots of cards is bad, while opening too many new accounts in a short time can temporarily lower your score because of hard inquiries and a lower average age of accounts. Having several well-established cards can actually be good for your utilization as long as you manage them smartly. Spreading your necessary spending across a few cards, keeping low balances on each, can lead to a lower overall utilization and lower per card utilization than piling all your spending onto one card. For example, instead of a $3,000 balance on one card with a $5,000 limit, that's 60% utilization. Having $1,000 balances on 3 separate cards, each with a $5,000 limit, that's 20% utilization on each and 20% overall. If your total limits are $15,000, looks much better to the scoring models. And like we touched on in secret number 1, making payments before the statement closing date is a super powerful way to manage your reported utilization. If you know you've spent a lot on a particular card one month, don't wait for the bill. Log in and make a payment to bring that balance down before the statement officially closes and that balance gets reported to the bureaus. This gives you direct control over what the credit bureaus see each month. Banks also sometimes use your high utilization as a reason to offer you other products like debt consolidation loans, which come with their own fees and interest. By proactively managing your limits and payments to keep your utilization low, you show you're financially responsible. You improve your score and you're less likely to need those more expensive credit products. The main message of this secret is take control. Don't just be a passive bystander with your credit limit and your monthly bill. Actively manage your limits by asking for increases when it makes sense. Smartly manage your balances across your cards and by making payments before statement dates. These actions directly affect one of the biggest parts of your credit score, giving you serious power over your financial profile, power that banks aren't necessarily going to just hand you. Beyond these 5 big secrets, a few other little things about credit can work in your favor. First, think about your credit mix. Lenders like to see that you can handle different types of credit responsibly, like revolving credit, which is credit card and installment loans, like car loans, student loans, or mortgages. Having a good mix can actually help your score, usually making up about 10% of it. Now, this doesn't mean you should run out and get a loan you don't need, just to have a better credit mix. But if you're already planning to get a type of credit you don't have, like a car loan, managing it well can add some good data to your report. Just be careful not to open too many new accounts all at once. Each application for new credit can lead to a hard inquiry, which can temporarily drop your score by a few points. One inquiry isn't usually a big deal, and its impact fades, but lots of them in a short time can look risky to lenders. Second, if you're building or rebuilding credit, secured credit cards and some of the newer alternative data reporting services can be really helpful. Secured cards need a cash deposit, and that deposit usually becomes your credit limit. They work like regular credit cards and report to the credit bureaus, so they let you build a positive payment history. Some services now also let you get credit for paying things like your rent, utility bills, or even streaming service bills on time, things that traditionally weren't part of your credit score. Experian Boost is one example. These can be great ways to get started or improve your credit. Finally, a slightly less direct point but still related, just be aware of how banks work. It's not strictly about your credit score, but understanding that banks use the money we deposit to make loans and investments. It's a system called fractional reserve banking. Gives you a bigger picture of their business. They're financial middlemen designed to make a profit. It's not evil, it's just business. But it really highlights why it's so important for us, the consumers, to be as informed and proactive as we can be in all our financial dealings with them, especially when it comes to credit. These extra tips, along with the 5 main secrets, give you a more complete toolkit for handling the credit world like a pro and making it work for you. And so let's do a quick recap of the 5 crucial credit secrets banks kind of hope you'll ignore. 1. Your credit score is way more flexible than you think. You have real power to change it with on-time payments, smartly lowering your credit utilization before statement dates, and regularly checking for and fixing errors on your reports. 2. Yep, you can negotiate credit card fees and rates. Don't just accept all charges. Annual fees, late fees, and even interest rates can often be waived, lowered, or negotiated with a polite call, especially if you're a good customer. 3. Maximize those sign-up bonuses and rewards, but be smart about it. Go for valuable sign-up bonuses and rewards, but always pay your balance in full each month to avoid interest that kills the perks, and make sure the card actually fits your spending. 4. Banks make money from your spending habits and your debt. Understand that banks earn big from interest on balances, especially minimum payments, and from interchange fees on every transaction. Knowing this helps you use credit more consciously. 5. You can manage credit utilization and limits to your advantage. Proactively ask for credit limit increases to drop your utilization ratio, and manage balances across cards or pay before statement dates to keep your reported utilization low. Knowledge really is power, especially with your money. Banks and credit companies have their business goals, and that's okay. But your goal is your financial well-being. By understanding these secrets, you're not just a passive pawn in the credit game anymore. You become an informed, empowered player who can make the system work for you, not against you. This means saving money on interest and fees, getting access to better financial products, and ultimately building a stronger financial future. You now have the insights to turn the tables and manage your credit with real confidence. If you found these secrets valuable and they've opened your eyes to how you can better manage your credit, please give this video a thumbs up. It really helps the channel reach more people. Now, I'm curious, which of these secrets surprised you the most, or which one are you planning to act on first? Let me know in the comments below. I try to read every single one, and your experiences can help others in our community too. And finally, if you want more insights like these to take control of your money and build real financial health, make sure you hit that subscribe button and the notification bell so you don't miss out on future videos. Thanks so much for watching. Remember, your financial education is your greatest asset. Keep learning, keep questioning, and keep building that better financial future. We'll see you in the next video.